So let me begin as more of our participants are joining. But just to say that we are on YouTube streaming live, and for those of you in the Zoom webinar, a very warm welcome. This is just after 12 noon here in South Africa, so good afternoon to everybody. Good morning to those of you who are still in the morning, and good evening if you're joining us from other parts of the world in the Eastern Hemisphere. My name's Elizabeth Sideropoulos, and I'm the Chief Executive of the South African Institute of International Affairs. It really is a great pleasure for us here at SIA to be co-hosting this event on Africa's economic transformation, looking at the role of Chinese investment together with the ODI. It's not the first time that we have collaborated together with the ODI on issues related to China. And so we're really very pleased that we're able to continue that collaboration in terms of broadening the discussion and the dialogue on China in Africa on these platforms. Before I hand over to my colleague Cobus van Staden, who will be moderating this morning's discussion, thought it might be useful just to reflect on a couple of points and the context for this kind of work that we're doing at the moment, and that the ODI has produced most recently about China and investment. This is, of course, in the context of the pandemic, the first time, the first year that the average growth in Africa is actually going to be negative for nearly a quarter of a century. So that's the severity of what we're dealing with. There is also significant concern about the extent to which the significant development, progress and development that we have seen again over the last 2 decades may be impeded and eroded as a result of the pandemic. And add to that a very constrained fiscal space, compounded by the debt crisis in many countries, and this is not just in low-income countries, but also in middle-income countries, and added to that, the climate emergency. I think you have the ingredients really for a perfect, potentially for a perfect storm. On the upside, of course, I think it's been really significant and important that in the context of the pandemic, I think African countries and African institutions have actually rallied and really done a phenomenal job of cooperating and coordinating, recognizing, I think, the severity of the impact on development, and recognizing and emphasizing the role that investment and building up manufacturing capacity on the continent in different sectors can play as part of a post-COVID recovery. Now, when this work was undertaken by ODI, of course, it was a slightly different context, but I think it's become even more important in light of the developments of the last several months. And we are, in effect, in 2020, 1/3 of the way towards hopefully achieving the Sustainable Development Goals in 2030. We know that that is really going to be a significant challenge globally as a result of the impact of the pandemic on development and the economies. So with those few words by way of context, I'd like to hand over to Cobus, and in handing over, I'd like to thank him in particular for driving it from a SIA side, this event. Also my colleagues in the broader communications team, our events manager, Sarasa, our events officer, Dumi, Nikki and Sipiwe from our digital communications unit. A really big thank you to you. And then, of course, to our colleagues in the ODI with whom we've had a really good engagement and cooperation. Of course, in first instance, Louise Shaxson, who's unable to join us this morning, and Erin Bailey Athias and Ariana Yoon, really a very big thank you from our side for it. And of course, the researchers, the intellectual heads on this report, who we will hear from just now, Linda Calabrese and Professor Tang. So, and that I'll leave to Kobus to introduce everybody. So really looking forward to the discussion, and welcome everybody, and hopefully it will be, I'm sure it will be a very stimulating engagement. Kobus, over to you.
Thanks so much, Elizabeth. Also from my side, thanks so much to the ODI for working with us on launching this report. It's really notable report. My name is Kobus van Staden. I focus on China-Africa relations at SIRE. And just before we start, just two requests. One is for everyone who would like to ask a question for the Q&A session at the end, to please post that in the Q&A section at the bottom of your Zoom window. Then we'll collate them and and present them to the presenters. And then we will also be circulating an evaluation form right at the end. And we'd be super grateful if you could fill that in. It helps us to target future SIRE events to the constituencies that really would like them. So without further ado, I'd like to introduce the first co-author of the report. Professor Tang Xiaoyang is Associate Professor at the Department of International Relations at Tsinghua University and the Deputy Director of the Carnegie Tsinghua Center for Global Policy. He focuses on political philosophy, China's engagement in Africa, and the modernization process in developing countries. Professor Tang, I hand over to you.
Thank you for inviting me to this event. Can you hear me clearly? Okay, so I will just start with analysis of the Chinese investments impacts on Africa's transformation from the micro perspective. My colleague Linda will talk about the macro perspective. So the micro level, we see the Chinese investment, they actually created quite a lot of jobs in Africa. And yeah, there are especially the construction sector and also the manufacturing sectors. But there are some difference according to different countries' regulations and also the nature in different countries. Manufacturing, usually they use more local labor, while more sophisticated jobs, maybe they bring a little more Chinese technicians. And but however, the training of these jobs, they are problematic, because most of these jobs, they are low and semi-skilled. And then the Chinese companies, they like to use the learning by doing manners to train the new recruited workers. But then the understanding is limited, although it's actually very practical to get the operation quickly started. And there are some companies doing the formal trainings or even sending them overseas for training. And there are also Chinese aid program providing technical assistance through like agriculture demonstration centers. And these are just yeah, but these are just a small part. And then we also see the firm level spillovers. That includes the horizontal spillover. That means the labor mobility between different companies, and also then competition between Chinese companies and the local companies. And usually this kind of competition, when it happens, it pushes the unproductive local firms out of the market. But actually we do not find evidence for broad upgrading of the sector. And that's possibly because the African market is so fragmented, and therefore we do not have a lot of big potential or drive for companies to introduce more technology. And then the lack of capital is usually the biggest obstacle for local companies to upgrade. And there's also vertical spillover. So namely along the value chain, downstream and upstream provide suppliers and clients. So the Chinese companies, they use often local suppliers and subcontractors, but these are only for simple work. And some more sophisticated workers, then they are given to the Chinese companies. And there are some technological and financial assistance provided by the Chinese companies to these upstream suppliers. And we also see forward linkage, especially in telecom, manufacturing, and agriculture and construction sector. There's we find the most beneficial way for local companies to learn technology from Chinese companies is through long-term supply and subcontracting or joint venture relationship. But these are relatively limited. Because this need time and also need the initial capacity of the local companies. Then in general, the productivity and technology perspective, we find the Chinese companies, they reduce the price of capital goods and facilitate the investment in machinery and technology by African companies, because usually the made in China products, they are relatively cost effective. And then we see the productivity growth, they are usually greater with the Chinese investors in Africa than from the OECD companies. Possible explanation is that the technology gap between Chinese company and the local African company is smaller than that gap between the OECD company and the African companies. And but we also see some danger for Chinese imports to deindustrialize the African countries, namely pushing a lot of African manufacturers out of the market and bankrupt. And then we also see the Chinese investment, they actually bring wage benefit and also livelihood improvement, especially the wages, they depend on skill levels and job tenure, work experience, and other factors. And in some high-tech level, actually, like companies like Huawei can pay very high wage. And then we also see Chinese, unlike other countries, investors, they offer additional social benefits like the dormitory and also some like micro loans for its employees. And but there are also some negative impact found. For example, they may cause the environmental degradation and cause the negative impact on livelihood of the people in the neighborhood. Okay, that's just my brief introduction, and I will turn it to my to the anchor. Thank you.
Thank you so much, Professor Tang. We'll go on to the second author of the report. Linda Calabrese is a research fellow at the International Economic Development Group at ODI and the China-Africa lead at the Evidence and Policy Group. Thanks, Linda.
Thank you very much, Cobus, and good morning or good afternoon, everyone. So Professor Tang talked about the firm and sector level impacts of Chinese engagement with African economies. And I'd like to focus on the sort of second part of the work that we have done, focusing on the macro aspects, on the structural transformation side. So here we try to investigate whether Chinese investment and Chinese engagement with African countries has led to a change in the structure of African economies, if it has led to a transition from low productivity traditional sectors towards more modern sectors, more productive sectors. I'll talk about this focusing on 4 points very briefly: the changing context in China, the impact of the investment themselves, the differentiated impact, and finally, if there's time, I'll touch on the labor issues. So the first point around the changing context in China, it's really important to understand what's the context in China to understand how that translates into outcomes in China's engagement with African economies. One narrative that was very much present a few years back in the discussion is that production is becoming increasingly expensive in China. So labor costs are rising, production costs are rising. So therefore, Chinese companies are becoming less competitive and they seek to relocate their production in other countries. And this was seen as an opportunity for Africa to grab, basically, this sort of role becoming production platforms for exports. However, the evidence we have reviewed for this report shows that actually Chinese investment in Africa are mostly interested in the African market, for the African market itself. So not to use African countries as a low-cost production for exports, as a low-cost platform for exports, but rather to service the African markets, to fill the gaps that are there in terms of specific products or services that are needed. So in a way, this sort of shifts the perspective of how we understand Chinese investment and Chinese economic engagement with Africa. On the second point, on the impact itself, we do see overall that Chinese investment contribute to a change in the structure of African economies. We see that the Chinese firms invest in new sectors, such as manufacturing, such as construction, which are usually more productive sectors of the economy, and therefore they raise overall productivity. We also see that this, in some cases, generates a virtuous cycle, a sort of positive feedback loop. Construction, for example, the construction industry or construction investment in certain countries have led to an increased demand for construction material. And this has in turn led to the creation of construction material industries in these countries that weren't existing before. And this has therefore facilitated investment not only by other Chinese investors, but also by other foreign and domestic investors. And then we also see that Chinese investment have, in some cases, or engagement with China has, in some cases, created whole new sectors that weren't really there before. So, for example, demand for specific types of resources, such as timber in Zambia, has created a whole new export sector for this timber specifically. And in addition to having a direct effect through investment, Chinese engagement with Africa also has an indirect effect through the support to the financing and the building of infrastructure. This facilitates, this sort of eliminates bottlenecks for firms that want to invest, and therefore facilitates investment, not only from other Chinese firms, but also from firms of other countries and domestic firms as well. So really, we do see this impact on structural transformation. However, and this is my third point, this impact is not uniform and it's not the same across all countries. Of course, even globally, we see these trends. So there's research that shows that Chinese investment has had a stronger growth effect in African and Asian economies and much less in Latin America, for example. But even within Africa, we see a lot of differences and a lot of different outcomes. And there's no time now to really go into the specific details of each type of, for each country. But overall, we see, for example, different patterns in resource-rich economies and non-resource-rich economies, where in resource-rich economies, you see that investment sort of generates fast growth in the short term, whereas the impact on non-resource-rich economies, such as Ethiopia or Rwanda, for example, takes place over the longer term. And then, of course, we also see differences between and within Chinese investment and Chinese economic engagement with Africa. And this is not just along the lines of the impact of private versus public enterprises. There's a lot more depending on the sector or the value chain that we're looking at. Even within the same subsector, so if we think about manufacturing, for example, we see that production that's more oriented towards, that's organized in global value chain and more oriented towards global competition and operating on very tight profit margins may have different impacts and different development outcomes compared to production for the domestic market, which operates according to different logics. Professor Tang has already talked a bit about the concerns about deindustrialization in certain African countries linked to Chinese imports. And of course, we have seen that in certain cases, but we have also seen the imports of Chinese goods, specifically machinery and equipment, has enabled the creation of new industries in African countries. So therefore, the structural transformation impact also comes through trade, not just through investment. One final point I'd like to touch on is specifically around labor and the workforce. So a lot of the evidence we reviewed had to do with job creation in African countries. Of course, that's one of the ways in which you quickly support structural transformation. And Chinese investment have contributed to large-scale job creation in many countries in Africa. However, this transition has not been frictionless. So moving a large part of the workforce from traditional, maybe less formalized, less tightly controlled activities towards more formal production system, towards factory work or construction work that operates according to different logics, has created frictions in terms of conflicts, in terms of high worker turnover, and so on and so forth. So therefore, there have been challenges. However, again, even here, the final outcome does not necessarily depend on the fact that this investment is Chinese or is not Chinese. It doesn't really depend on the origin, but it has more to do with the domestic context with which this invest interacts, but also with the sector and with the value chain that we're looking at, for example. So there's a million of other things I'd like to say, but I think I'll stop here now, and I look forward to the discussion.
Thanks, Linda. These findings are so fascinating. We are going to unpack the findings through a panel of three experts commenting on various issues in relation to the report. We're delighted to welcome Anzetse Were, who's the first respondent. She's an economist at FSD in Kenya, and she's based in Nairobi. She has worked on economic research and analysis in the African context over a wide range of issues, particularly focusing on macroeconomics, manufacturing, the informal economy, and the private and financial sector development. Thanks, Anzetse.
Thank you. And thank you very much for having me and giving me this opportunity to share my thoughts on this report, which I found to be really lucid and insightful. So I think first, I just want to share my immediate responses to the report and the presentations, which were wonderful. Thank you, Dr. Tang and Linda, thank you. And then I'll just sort of give a snapshot in terms of the macroeconomic trajectory and get insights on the Chinese role there. I think, first of all, the first thing that really struck me is that from a macroeconomic perspective, we're seeing the role of industry and technology coming in through the Chinese private sector as a role of updating African manufacturing capacity. I think if you look at the way a lot of either older manufacturing players in Africa or some of the newer ones, there has been a struggle around integrating innovative and effective technology into how they operate. So I think it's been really quite interesting to see how the Chinese presence is playing that updating role. At the other side, there is this tension where we're seeing this sort of almost second wave of the industrialization that's informed by Chinese presence. Obviously, the first wave of premature deindustrialization, one could argue, happened sort of in the early 90s, when I think many African countries opened their markets, having not industrialized. And so the uptake of the manufacturing capacity in China itself sort of informed this premature deindustrialization. So I think it's interesting seeing this new rise where there's an anchoring in of Chinese manufacturing and investment activity in Africa, but not necessarily in a manner that centers indigenous players. And it will be interesting to look at the implications of premature industrialization in terms of the African players, rather than just the presence of industry. I think the third big thing that really struck me was this issue around productivity and the incentives to be productive. I think their assumption always is that, oh, African labor, it may be cheap, but it's not productive. This is a problem. But I think what this research really articulated, I think quite lucidly, is that the motivations for pushing for productivity depend on market access, right? So I think to the point that both Dr. Tang and Linda have made, when you're dealing with very fragmented markets, number one, and where you're dealing with, in a context where there's not a lot of market information in terms of allowing firm level decisions to decide which markets to expand to, whether that's within Africa or using, for example, the tariff structures that a lot of African economies have for richer economies. If that knowledge isn't there, then sort of the push towards being productive for the sake of being productive, I think is something to think about. And I think it will be interesting to see going forward, the spaces where enabling African labor to be more productive actually makes sense and pays off, and the spaces where there's a bit more flexibility around, this sort of new obsession with the productivity of African labor. So I found that very interesting in terms of the link to market access. I think the third thing that I found really fascinating is this sort of how the Chinese firms are almost in this middle space, sort of between the large sort of micro, small, and medium enterprise that are African players. Then you've got a very large corporate formal structure that tends to be quite dominated by economy or by players from richer economies. And then you've had the Chinese firms, the sort of straddle, this middle layer, which I think makes a lot of sense if you're looking at the developmental proximity between a lot of African economies and obviously the Chinese economy. We've seen the rise of the Chinese economic, style. And I think the interesting thing from an African perspective is the transition out of informality that engendered in the Chinese economies. So it's very interesting, I think, to look at this from what role will these Chinese firms play in either integrating a lot of the more informal micro, small, and medium enterprise, the points that were made about sort of vertical and horizontal linkages. What role will they play in nudging micro, small, and medium enterprises towards more formality that makes sense for those firms rather than some ideological position? And then the second thing will be, will there be a comfort with a certain, with the way the micro, small, and medium enterprises, particularly in Africa, operate, because often the global north has a certain view that they should be formalized and this is the only way you can develop. So it will be interesting to see going forward how that plays out and how Chinese firms continue to interact with the fact that the bulk of African labor will continue to stay, sort of in the informal in the informal space going forward. I think just to wrap up quickly, there are really three things that I'd love, sort of future research to consider. I think sort of first is the reality of growing multipolarity from an African perspective, where obviously we have China, we have the traditional players, the US, the UK, the EU, but we also have a lot of and Japan, but you also have a lot of these newer players, the Indias, the Turkeys, the UAEs, the Russias, also with their private investment and private sector capabilities, and how will Chinese firms interact? Will it be more of a collaboration? Will they be a competition? I think this is a real reality going forward. I think the second big thing I'd really want to look at is the role of the Chinese firms in African recovery from COVID. I mean, I appreciate that this report was obviously written pre-COVID, but when you're looking at the specificity of how COVID has impacted African economies at subsector and even at value chain, it will be interesting to see how that galvanizes or disincentivizes deeper Chinese firm activity to foster recovery, particularly at sectoral level. I think obviously the issue of African debt will be one that will certainly be an overhang for the Chinese government in particular, and how do you balance that with this need for continuous stimulus by African countries? And I think finally digitization is going to be a very big thing. I alluded to technology, but I think it will be interesting to see where the nexus ends up happening around automation and using that, but also leveraging digitization and digital platforms in the spirit of African economic transformation. And obviously the reason why I say this is because obviously digitization is a story that people like to tell about Africa, but the other reality is that this is a very big space around rivalry and sort of the reality of the geopolitics globally right now where China is centered. So I think those would be, for me, very, really interesting areas for future research. Thank you very much.
Thank you, Ansetse. Next up is Leslie Wentworth. She's the managing director at Tutwa Consulting, where she focuses on managing complex multinational programs aimed at enabling collaboration between regional governments, multilateral institutions, and the private sector. She has extensive experience in the fields of political risk, international investment, and trade facilitation. Thanks, Leslie.
Thank you very much, Cobus. Much appreciated, and my thanks also goes to Saya and to ODI for this very generous invitation for Tutwa Consulting and myself in particular to participate. I want to congratulate Professor Tang and Linda for the publication, and indeed for the presentation. Linda, you're right. I know that you could have gone on at length in terms of what is to be said in the context of the Chinese experience in Africa, and indeed I've had to limit my input in terms of what I am going to feed into the conversation. I've been asked to look specifically at trade and investment and to look at it in the African context, but relevant to the COVID and post-COVID recovery phase. And I think what is significant is what Elizabeth started off the conversation with earlier on. We have been profoundly affected in terms of trade and investment in the past year. Now, I think UNCTAD reckons that we've lost about 49% of global FDI in the past year. We've looked at a loss of about 27% in merchandise trade across the past year. And in Africa, this translates into 17% of trade lost. And we're reflecting somewhere between 25% and 40% foreign direct investment that will result in terms of a decrease in FDI over the course of 2020. So these are significant sums that we're talking about. We are in recession. Africa is in recession for the first time in 25 years. We've seen economic shutdowns across the globe. We've seen the rise of protection as a result. And I think that what is important to note in the context of the Chinese juggernaut, the export juggernaut that we refer to, we've seen that many of our African countries who have been tied into global value chains have realized that these are significantly Chinese value chains. And as a result, many are left flailing, unable to pull themselves out of what has been a significant loss in terms of trade. And these, herein lies the rub, herein lies I think some of the lessons for Africa going forward in terms of, reflecting on what the necessary actions and reactions to the COVID pandemic. Certainly there are massive opportunities, and we looked at it. We've been put in a position where we could quite easily reflect on where we've gone wrong in the context of industrialization, in terms of infrastructure, in terms of reliance on the partners that we have outside of Africa. What are these partnerships meant to look like? What are the best types of partnership in order to develop, to grow not only the economies of African countries, but the capabilities and capacities in terms of skills, in terms of technology, in terms of the ability to develop our own value chains in order for Africa to really robustly develop. These are areas that we need to be looking at: nearshoring opportunities, reshoring manufacturing, and growth of global global value chains that are actually initiated in the African context. There are deep lessons to be learned from our partners, such as China, and I think that governance in the context of the African continent, in terms of African political economies, are very, very important. Governance is very important. We need to ensure that we manage the partnerships on an equal basis, on an equal footing, that we develop skills not only from the perspective of jobs that are created in African economies, but in terms of the management processes, in terms of actual governance of projects, so that the relationships are much more at an equal footing. Upgrading that we talk about in terms of manufacturing processes need to reflect right the way through in terms of processes that lead to upgrading of skills, upgrading of business and business personnel that allow these partnerships to exist and for our economies to grow. I think that really picking up on Anzetse's point relating to the digital focus, definitely I think that it's absolutely crucial that our African countries take a much more resolute stance on building the capacities in terms of the digital space, and this has been revealed in the context of COVID-19. You know, we need the policy space in order to ensure that spectrum and additional bandwidth is rolled out. This needs to be ubiquitous. This needs to be a process by means of which communications, education, business, trade, and investment is rolled out digitally, is able to be rolled out digitally. This builds the resilience of the economy, relying on our digital communication mechanisms. And I think that with this in place, the infrastructure that is developed in this regard, this will no doubt lead to a much better prospects for us in terms of trade and investment, but on an equal footing with our partners. So thank you. Let me stop there and hand back to Cobus.
Thank you, Leslie. Finally, we're very glad to get commentary from Hannah Ryder. She is the Chief Executive Officer at Development Reimagined, a pioneering international development consultancy in China, advising in particular Chinese businesses on how to invest in Africa sustainably, African businesses on how to enter the Chinese market, and working with governments, UN bodies and NGOs to strengthen their own China-Africa policies. Thanks, Anna.
Thank you, Cobus, and thank you to Saya and ODI for the invitation to join this launch, and congratulations to you all on the launch of the new report, and in particular, Professor Tang and Linda Calabrese. Now, as Cobus says, I was asked to present a view from China, as that's where my firm is headquartered and most of our clients are. And so what I want to do today is look at not just the report, but add value by exploring 4 aspects of China's new strategy towards Africa, and what this report helps us to understand better about the way forward for Africans in particular. So the first aspect is made up of 2 words: dual circulation. This is China's new 5-year plan, the bedrock of China's new 5-year plan or strategy, with the added point about a new target for China for 2060, carbon neutrality by 2060, in order to address climate change. Now, we believe, many Africans and others outside of Africa do not necessarily understand or even know about this new strategy as yet, just like the Belt and Road Initiative or Made by China 2025 when that came out. But right now, while we do hope for many more opportunities, and we will be having, I'm sure, many deeper discussions on these topics, this report from Professor Tang and Linda and others who contributed to it really indicates that this strategy could pose some challenges for African countries. In particular, while countries exporting raw goods and agricultural products to China might continue to have products in China, even new markets opening up and growing, so seeing trade grow in general, for example, for minerals, for electricity vehicle battery production, or even agricultural product exports to China. It's not clear whether the dual circulation strategy will necessarily continue to drive outward foreign direct investment from China, and to what degree that will involve use of African labor, and therefore enable the countries to upgrade their own production and add value to products in country and then export to China, for example, duty-free and without other trade barriers, which is their ultimate aim. The dual circulation strategy is very much around a plan for self-reliance from China, which may interfere with these plans. So Africans and others, of course, need to study the plan carefully at this stage and use reports like this to think about how to enable those opportunities to open up. The second issue I wanted to, the second aspect of China's strategy towards Africa is this question around debt issues in Africa. Now, the focus in China seems to be a lot less alarmist than the rest of the world, and this is an approach which my firm certainly endorses. We see a bigger focus in China on how to reignite growth, including through what this report talks about, through trade, through foreign direct investment, through completing existing projects, avoiding delays, and so on. And indeed, in a post-COVID-19 time, it is very important to ensure that all the loans that have been taken from China in particular are focused on productive investments, that they're focused on things like digitalization, which Anzetse was talking about and Leslie was also talking about, that they're also focused on transport and smoothing logistics, employing local people to provide the jobs, which Professor Tang Xiaoyang mentioned is still a challenge. And also, of course, avoid the other green rhino, the other grey rhino, sorry, in the room. COVID-19 is one, the other one is climate change. How can all of these investments be as green as possible, and especially in terms of energy investment? So that the report helps us to understand that these are still issues to be worked out, and by no means has that answer been found, particularly in terms of issues such as providing local jobs. The third issue is that from China, we see a huge focus on trade with Africa, increasing trade with Africa. There has been a new, there's just the third China International Import exhibition has just finished in Shanghai. Last October, we saw a new foreign trade agreement with Mauritius, the first African country having a free trade agreement with China. And several other African countries have made new agreements around specific products with China for their market entry. We also know of at least 2 new free trade zones that have just been launched literally in the last couple of weeks. And that's very welcome and potentially of huge significance. And these are focusing on some of them are focusing on Africa in particular. Now, these could be of huge significance, especially if they do enable, as I was mentioning earlier on, the duty-free import of value-added goods from Africa to meet China's high-end consumers, linking onto various e-commerce and face-to-face platforms, not just agricultural raw products. That would be very useful. But as Linda mentioned in her presentation, we are still not seeing this really in huge numbers. We're not seeing any Chinese firms, for example, relocating to Africa in order to export to China, even with regards to some of those agricultural products. That in itself, and certainly if they were manufactured in higher added value goods, that would be a real game changer. But it doesn't seem to be what is happening right now. Last but not least, foreign direct investment in general in post-COVID-19. From China, this does seem to be holding up in Africa despite COVID-19. We've seen a new investments, and as Linda and Professor Tang were mentioning, many of these are continuing. The growth in foreign direct is happening, but it hasn't actually grown as fast as it should have. So many of you will remember that the Forum on China-Africa Cooperation in 2015 was held in South Africa. At that conference, there was a target agreed of $100 billion of US dollars of foreign direct investment from China into Africa by 2020. And that's clearly not going to be met. And it wasn't going to be met before COVID-19 either. Right now, it stands just over 50 billion US dollars. And coming back to the report from SIA and ODI, we have not yet seen the structural transformation in that foreign direct investment. It's not particularly differentiated. It's clustered in certain countries. And again, it's mostly focused on African markets. Now, that's not just to do with China. It's also to do with other countries' free trade agreements with African countries and the way they trade with African countries. So, for example, are there opportunities for Chinese invested companies to export value-added goods to these external markets? There are also issues around undercutting of local manufacturing, for example, for pharmaceuticals, with cheap medicines procured for very good purposes, of course, but they're not using local production. And that really does have a really negative impact on local manufacturing and the prospects for investing in local manufacturing from a Chinese perspective. So these are not simple stories. And of course, what this report helps us to really understand is the state of play right now. But what we also need to think about is where do we go with this type of, with this information, and in terms of a future strategy. They really reinforce, and the 4 points I've tried to make today really reinforce the needs for African governments and, in a sense, citizens, I guess, to be more intentional and much more demanding with respect to their agreements with China, as well as other partners when it comes to trade and foreign direct investment. It is not just a simple story of we just need to work with China and that's it, or we're going to work with everybody else and we can't work with China. All of these, we live in a globalized world despite COVID-19, and we must work together and try and find a way through with an African perspective. So with these 4 observations, I will end. And again, thanks SIA and ODI for the invitation to share my reflections, and look forward to a great Q&A session. Thank you, everyone.
Thanks so much, Hannah, and thank you to Anzetze and Leslie as well. It's fantastic commentary. We're moving on to our Q&A section now. Just before we start with that, just a reminder that we are posting. We will post in the next few moments. We'll post an evaluation link, in the chat, and you can. We'd be very grateful if you could add some of your impressions there, and kind of that, which will greatly help us with future events. Thanks so much for that. So please feel free to add questions in the Q&A section. I'm going to start off with a question to Professor Tang and to Linda. Just one of my own, and I'll group questions together to give you a few to respond to at once. From my side, debt is at the moment a particularly kind of prominent issue in China-Africa relations, as Hannah has responded, and different people are different at different levels of alarm about where kind of where we are at the moment. Just for some context, tomorrow is the date where a group of private creditors to Zambia will vote on whether they will allow Zambia a repayment holiday in its commercial debt. At issue here is that apparently Western private investors are feeling anxious and upset that so far there's been relatively little disclosure of the amount and the terms of Chinese debt to Zambia. So this is potentially really a big crisis if there is if Zambia doesn't get its repayment holiday tomorrow, it will then officially be in default on Saturday, which will be the first African default in a very long time. So I wanted to just touch base on that issue with Linda and Professor Tang in terms of how, from the background of your research, what role is the debt issue playing in the wider context of China's development impacts in Africa? Then also from Thierry, we have a question. He says, you talk about investment, but how do you put a figure on the amount of this investment? Because the available Chinese data does not show that these investments are significant. In fact, you are probably talking about investments in units that are not capital intensive, but labor intensive. So what is the technological impact? And I wonder if you could then also just talk about this issue of capital intensive versus labor intensive, in your analysis. Maybe we should start with those two first, and then we can add more.
Shall I maybe start with a few words, and then Professor Tang can add? So I think these are two excellent points. So specifically on the debt, because the sort of the work that we didn't necessarily focus so much on infrastructure. We haven't touched on it in the report. But of course, this is a huge and very important issue. Even if, as Hannah said, and I agree, there's like, the alarm is probably misplaced in the way it's been, sort of discussed globally. There's a lot of other issues at play. Of course, it's not just debt. It's not just money owed to China, it's money owed to other countries, it's money owed to private investors and so on. So there's a lot of things that need to be discussed here, I think. But the fact remains that this is something that's making a lot of countries nervous. Here, I'm not just talking about Africa. Many countries in Asia are also sort of trying to think a bit more critically about the way they borrow, because of sort of narratives that exist around debt risks. I think this is something that's definitely very important, especially in the COVID-19 context, where having to repay money to your debtors also means that you can spend less on other priorities that you may have in terms of health and social services and so on and so forth. So this is definitely something that is important and is probably posing a challenge in the relationship between China and African countries. But I think it's potentially a matter for a more complex discussion than just sort of whether you owe money to China and what does that mean. So yeah, I would say there's just more to it than what appears on the surface. On the investment specifically, on the second question, yes, I agree. I mean, we know that in terms of stocks, of investment stocks, China is not the main investor in Africa. However, we know that Chinese investments are very diversified in terms of sectors. So if you look at the top investors in Africa, US, UK, France, Netherlands, they mostly invest in extractives and financial services. Whereas Chinese investment also go in manufacturing, construction, of course, extractives as well, of course, financial services as well. But it's just a lot more diversified and therefore can help diversify the structure of African economies as well. And in terms of the capital versus labor intensive issue, I think it's also a matter of what do countries really need? So, for example, I do a lot of work in non-resource rich countries, and these are countries that generally tend to, want to really create large number of jobs in the short run. So really capital intensive investment may not be the solution that may not be the thing that they need, because then it ends up employing very few people. So for example, work I've done in Rwanda shows that there's a factory, a flour factory, they mill flour basically from wheat. And it's super capital intensive, state-of-the-art technology. It's really, you know, the best machinery that you can buy. And then it employs like 10 people. Whereas sort of more labor-intensive industries contribute to the ambitious goals in terms of job creation that Rwanda has, and therefore are really beneficial, not only beneficial to the global economy, to the Rwandan economy, but also really fulfill the goals that the Rwandan government has set for itself. So it's really what the Rwandan government thinks is beneficial and is needed in the country.
I agree with almost everything Linda said, and I just want to add something about the debt. And so for Chinese government, actually also has a quite large stake in Zambia. But I think a big difference than we can see in this Zambia debt crisis right now, the Chinese government is willing to restructure and renegotiate the debt, although Chinese government currently do not easily cancel the debt. Only for very specific, like zero interest loans, there may be a cancellation, but other loans, when they are commercial loans, then the Chinese government will keep it, and but then will be willing to flexibly adjust it, especially when it's now the COVID crisis, and Chinese government delay the payment and restructure is gives the African countries some relief in terms of repayment. And so this is just one feature for this Chinese debt arrangement. Another important thinking of Chinese debt, Chinese like this debt or lending practice is China is also reconsidering the criteria and the practice of lending. So I think for the past decade, maybe because of some high price of commodity and this over optimism, then African countries, they have borrowed quite a lot. Actually, a large part not necessarily from China, but a large part from the Eurobond, from the financial market. And then China, but however, now tries to be more strict on giving the debt, but also on coordinating the investment together with the debt. A large problem for the debt burden is the productivity of this financed infrastructure and facilities are too low, so that they cannot even pay the interest, let alone the whole repayment. Therefore, then the Chinese government, now when they approve new loans or new projects, they look at this productivity and the possible revenue from these loans and facilities, and tries also to coordinate maybe more investments to help this productivity growth of this projects. Yeah, thank you. That's just my 2 cents.
Thanks so much. 2 more questions, both relating to free trade. Garth asks, how should Africa position the Continental Free Trade Agreement in relation to Chinese investment? And then Steve asked, what impact do you think Chinese investment may have on the AU's quest for economic integration? So roughly kind of like different perspectives on the same issue. I wonder if Professor Tang and Linda can comment on the role of free trade, and particularly the African Continental Free Trade Agreement, and how they see that shifting the impact of Chinese investment.
Sure. So I've actually seen a very beautiful map recently of, I'm a trade economist, so I really enjoy these things. I have seen a really beautiful map of trade corridors in Africa. And the map was existing trade corridors in blue and planned trade corridors in yellow. And the planned trade corridors were a lot more than the existing trade corridors. So this really shows that there's a huge need for additional infrastructure for the African Continental Free Trade Area to actually come into place. You can have, all your all the free trade agreements you want, but you also need the infrastructure to actually trade the goods. So in this sense, I think it will be really important to continue to focus on infrastructure development to realize the continental free trade area. In addition to that, also the role that foreign investment in general, not just Chinese investment, can play, what we discussed about in terms of potentially supporting development of knowledge and of capacity and so on and so forth, to make African produced products more sophisticated for better, more value-added trade even within Africa. I think it's still going to continue to play a very important role.
Yeah. For me, on my part, I would just like to add one point. I think the free trade, continental free trade agreement will be very helpful for the digital sector to grow, because China has this quite developed e-commerce sector, and a large, a very important condition for the e-sector to grow is to have this flow of logistics and also money and all this related connectivity. And I think the free trade agreement will be a large, very important help for the digital sector to develop also in Africa. And I know actually already there are quite a few Chinese e-commerce big players, including Tencent, also Alibaba, etc. They are all interested in the continent, but currently I think they are just at the experimental stage. Maybe we can expect a bigger rise after this COVID, actually together with the COVID recovery, post-COVID recovery. Yeah.
Thank you. I think we should give our main authors, Linda and Professor Tang, a 5-minute break from answering questions and turn to Hannah, Leslie, and Anzetse. There's some questions specifically coming through for you. I wonder if the three of you could respond to two issues. One is Hilaire asks, what can the Chinese government do to encourage more collaboration between African entrepreneurs and Chinese counterparts in the private sector? We've seen attempts, for example, from in the G20 from Germany to try and through their compact with Africa to try and facilitate ties between German companies and various actors in Africa. Like what the three of you think about the possibilities of work from the Chinese government side on this issue. And then Lauren asked, what policy shifts or initiatives you think are needed to empower African firms to improve their productivity towards more explicit growth opportunities? So Anzetse, Leslie, and Hannah, if any of you want to start.
Yeah, sure. I'll start. I'll start with the productivity question. It's a really, really important one, because if you're talking about it macroeconomically, in terms of the ability of African governments to generate the revenues to pay off the debt, or if you're talking about it at firm level, and therefore the ability to anchor in deeper investment and to foster deeper growth. I think one of the biggest concerns, to the point around, more productive growth and deeper sustained economic growth is that a lot of the conversation on productivity in Africa stays at the firm level. It's a very firm level conversation, of usually blaming firms, for African firms in particular, for not being productive. And I think one of the real ways that I think that, to boost the economic growth question is to look at the macroeconomic context in which productivity exists, particularly if you're looking at it at an African firm level, and therefore how African firms can better engage with Chinese firms, and all other firms. And then that's when you get into the realm of informality. I think, quite frankly, one of the biggest productive bottlenecks in Africa around private sector activity and therefore revenue generation is that business environment, legislation, policy, and efforts does not bear the micro, small, and medium enterprise sector in mind, which is the bulk of where African private sector and labor actually sits. So if you look at things like the ease of doing business or all these initiatives around improving the enabling environment for private sector to function, the bulk of African private sector is really not part of that story. As a result, the external factors that negatively inform the ability of African private sector to be productive I never talked about. You know, we're looking at very basic things like market infrastructure, access to capital, access to skilled labor, the ability to function without the fear of, you know, whether it's government corruption or all these other things that hang over the minds of when African private sector, you know, does its work. And even things like premises, you'll be surprised how the inability of a lot of African private sector to have a premises that is secure, that is safe, and that is kitted out properly has a real impact on their ability to be productive. And I think the other big macroeconomic question that sticks and is a bottleneck is the market access issue. Again, if there are efforts often to increase access to markets, either regional or global, those tend to be positioned in a way where the barriers to access are such that very large formal firms, unless you're talking about very small sort of, you know, border trade phenomena. But when you're talking about very large trade agreements, you know, linking to the point around the African Continental Free Trade Area, there's almost no effort to help micro, small, and medium enterprise firms or indigenous African private sector to have a lived understanding on how to leverage them and therefore have the incentive to be more productive because there's a market opportunity that they can sort of take advantage of at the back end of that. So I think the lack of this ecosystem approach will be one of the bigger bottlenecks of the African Continental Free Trade Area. I think in addition to all the issues around agreeing on tariffs and then on tariff barriers, and that will probably take years, I think the real bottleneck will be the information asymmetry and the barriers, particularly in terms of capital and knowledge and information, that will then make it very difficult for the bulk of where African labor operates for that to have a lived impact on how they access their markets. I think in terms of the Chinese role on that, I think one of the deepest roles the Chinese government can play right now in terms of fostering capacity in Africa, private sector African economic activity, is to hold Chinese firms liable to legislation in China when they don't behave on the continent. And I think if that can be a sort of way in how the Chinese government interacts with Chinese private sector firms, I think it will create a much more transparent environment that would allow much deeper collaboration to happen. I think the rest is up to African governments. Thanks.
Thanks to Anzitsi. I think you articulated the answers beautifully in that space. Maybe just to follow up on that point, relating to potential private sector collaboration across continents, across Africa vis-a-vis China, we've seen that wherever you look towards private sector on private sector collaboration, you know, because of the nature of business and because of the nature of the functions, the operational functions of the private sector, any sustained level of activity needs a systematic approach. And we've always found that being able to organize the private sector on the basis of dialogues, and here we talk about the collaboration, the support of government. I mean, we've seen how in the case of China, the involvement of government and state-owned enterprises have actually supported the inroads that China has made in the continent. And so this approach, where government recognizes the worth of their private sector and actually begins to initiate in a non-interventionist way this collaboration between private sectors, amongst private sectors, in order to build this dialogue, you know, you then are able to create a sustained an ongoing process of collaboration. In terms of the productivity question, the Economist has dealt with it, both in terms of the micro and the macro approach, but maybe to take it even a level higher, relating this back to what is happening on the continent, the kinds of processes that are rolling out from the African Union. And here I talk about the industrialization, the reindustrialization processes, the acknowledgement of the network services, the tradable services that is so significant, so important in the context of industrialization, the boosting intra-African trade initiatives, and the industrialization, the PIDA projects that have been on the lists, the wish lists, and the development lists of the African Union for many, many years. I think that with the personnel that we've actually seen, highly skilled personnel now taking office within the African Union and African organs, intergovernmental organs, the modern move towards the ongoing collaboration with partners, as I say, partners on equal footing. These conversations would then be able to look for the connections between these processes, the PIDA process, for example, with the Belt and Road Initiative, so that there is a true process of China coming in, or any other partner, the EU, the USA, hopefully, partners in the Pacific, coming in and working together with African bodies in order to ensure that the good is achieved, the public good is achieved for citizens of Africa. So I hope that touches on some of the questions also posed in the Q&A. Thanks, Cobus.
Okay, so my turn. My apologies. The screen is not very good because of the light here. Let me just check. Let me just deal with that. Hold on 1 second. Let me remove that. It's very odd. Okay, that's better. So let me respond to a couple of questions, and I want to again kind of add value to what has been said already. I very much agree with the importance of dealing with, of course, kind of pushing the African Continental Free Trade Agreement as much as possible, increasing focus on SMEs and MSMEs in that, as well as involving China in terms of trying to support the infrastructure. But this I think brings me to a broader point and goes also to this question about debt. I think, and again, it also goes back to this Chinese perspective on debt, which is the key issue here is about the productivity of the investment, and are these investments, you cannot have a impactful free trade agreement unless you do have logistics working. You can't have e-commerce working unless logistics are working. You can't have digital education unless you have infrastructure that enables that digital education. And infrastructure doesn't come for free. Infrastructure doesn't come from the private sector typically. It does involve some kind of borrowing into the future. So we really need to take this question very seriously. COVID-19 has brought it to the fore, of course, because governments are being forced to really think about the opportunity cost of existing debt payments that they have to be, debt servicing payments that they have to make. But it still doesn't, whatever happens, does not at the moment resolve the really big existential question of how do we plug Africa's financing gaps that are very real, infrastructure financing gaps, in order for things like the Continental Free Trade Agreement to be a success and for delivery of the Sustainable Development Goals in Africa. So I think this remains a huge question, and trade in itself, aiming for trade and aiming for investment in itself is not going to solve that question. Now, so we really do have to work on that. I wanted to answer a question that have two questions that came up specifically. One is about coming back to a point that I'd made about China's dual circulation strategy and whether that will affect Chinese investment in Africa in the near future. That was from Wan Junwu. And I think there is a real challenge there, and we really need to analyze the dual circulation strategy and see whether there are still incentives in place for Chinese firms to go out to Africa to begin to do the kind of foreign direct investment that Professor Tang Xiaoyang and Linda have put together in this, analyzed in this report. And much more of it needs to happen. Africa envisions itself, African governments envision themselves as delivering on a post in Agenda 2063 as the global manufacturing hub. That doesn't mean just trading within Africa. It means being the global manufacturing hub. How is that going to happen? It will need Chinese investment, almost certainly. It will need foreign direct investment from China to move manufacturing to move from China to Africa, but it will also need other partners to open up their markets to goods from Africa. And that still is not the case. It's not happening enough. Last question I wanted to answer was a question from Alonso Soto about G20 finance ministers. And it's focused on debt, which is not the topic of this report, but since we have an opportunity to discuss these questions, I think it's worth reviewing, because it's also about the outlook from China towards African countries and the outlook of other countries towards Africa. The question is around whether there's going to be a set of common principles and whether China would adopt those with the Paris Club. I think it's worth noting that I have not seen particular calls from African leaders for China to adopt a set of common principles. These calls have come from the Paris Club and from the World Bank and others. I think what African governments appear to be most interested in is the delivery of the sorts of debt service, the pushing back of the debt service repayments, as well as potential restructuring if needed, in order to create that space, that fiscal space. That does not mean necessarily coordinating with Paris Club. From the Chinese perspective, it's not clear to me that there is an interest in coordinating with Paris Club. I mean, fundamentally, the question is, does China have a diversified enough portfolio of debt to be able to manage what is happening if there are some defaults in Africa, or if some of the projects are not working very well? And it's not clear to me that China is over invested or over, in terms of the loans at least. Loans are much more differentiated across the continent and much more dispersed across the continent than FDI, for instance. And so that there doesn't appear to be a particular interest. Why would that be necessary? And it's not something that African leaders are necessarily calling for. And the most important thing is coordination and communication between African countries and Chinese government, and ideally coordination between African governments themselves with regards to China. That's the coordination, that's the transparency that matters, not with Paris Club.
Thanks, Hannah. Yeah, I think that's a really powerful point. So we're heading towards the end, but we still have a little bit of time. Returning to Professor Tang and to Linda, two questions for you. From Ines Ngube asks, are you seeing any discernible policy changes or shifts in African states geared at facilitating Chinese investment? If there are such policy changes or shifts, to which extent are they sensitive to leveraging Chinese investment for the development of the African private sector? And then from Manling Yang, how do you evaluate the role of Chinese SMEs that engage in the African market without necessarily being detected or regulated by the Chinese government?
Maybe let me start with the role of the sort of policies of African governments towards Chinese investments. Here, I cannot really reply for all countries. With the 50 plus African economies will have very different ways of approaching this. My work in the past has focused very much on the countries that have seen less of Chinese investment in recent years. So we know that there's countries such as Ethiopia, for example, that have seen huge inflows of Chinese investment and have developed a really sophisticated way of dealing with those, with specifically appointed people within their investment promotion agencies or specific strategies to attract this investment. The countries I work with, sorry, are countries that have received a lot less of this investment, and therefore their thinking is not very much developed on these topics. So I'm talking specifically about Uganda, Rwanda. I see that there's very little understanding, not just of the way they can attract the investment, but even of the understanding of what is already existing, what is already there in terms of Chinese investment. And in these countries, the major, most important point is really to actually first understand what you have and then use that as a way to further leverage investment. Maybe Professor Tang wants to answer specifically on the SMEs, but if he doesn't come online, and I don't see him online. Oh no, I see him online. But if he doesn't come online, just a few words. Yeah, I mean, it's correct. We are all aware of firms that are not registered, that may be smaller in size, and therefore, you don't see them as recorded in the sort of official government records, maybe because they don't need to receive government incentives, or they don't need to, receive tax rebates, and therefore they don't see much incentive to register. This, of course, applies not only to Chinese firms, but also to other firms from other countries, domestic firms as well. I mean, of course, it's a lot more difficult when you deal with SMEs that are sort of off the record to make sure that they behave in ways that are sort of positive from the investment viewpoint, from following environmental regulations or social regulations in terms of labor, wages, and so on and so forth. I think this is definitely a big issue. But the question is whether the impact overall that these firms have is still regardless positive or is positive on balance or not. And if it is not, what does it take for it to become positive? So what does it take for these firms to basically leverage the presence of these firms to actually achieve the impacts that you want in terms of job creation, for example, or in terms of technology transfer, but also make them respect regulations that are present in the country? I think this is a question that's still not solved and that needs a bit more attention.
Okay. Yeah, so I would like to just also address these two questions Cobos just asked. One is about the African countries' policy to leverage the Chinese investment. Actually, I don't see when it comes to African countries' policies, I don't really advocate a specific policy towards Chinese investment, but it should be the same for all the foreign investors or even all the investors. And I think that's the biggest problem or obstacle in a lot of countries' policy. Namely, they do not really do not take the investors' interest into account sufficiently. And that's actually a larger key success factor of Chinese reform and opening policy. Actually, in China, a lot of foreign investors, they just feel all the convenience. And this is something I think African countries should work on. And they should just take the investors' interests as a priority. And in fact, that's also the key to a lot of questions we discussed in the in our discussion. For example, also about the Chinese companies connection with the local enterprises. The key, like most critical or the best, most efficient way to forge this connection is also through market. So the African government should just encourage the market and to help the encourage this market and to force. I don't know, is it working? And actually, I'm not sure my network is that working well. And then to hello.
Yes, it is working.
Oh,
yeah, we
working.
can hear
okay.
you.
Good. Okay, thank you. Yeah, so the market, I think that's the most important element for the Chinese companies to invest and to grow in Africa. But then it's also the best way for them to work with the local companies. And that's also another regarding this, but I do not mean it should be a free market as the neoliberalism states. It should just be a pragmatic approach to nurture the market. And I actually try to, maybe this is a long topic, but I just want to say, actually, even when the Chinese SOEs, they operate in Africa, they work rather in the principle of market economy, but not really like follow political and other agendas. So take the business seriously. That's just, I think, catchword. And that's also the same for the SMEs. Like another question asked about whether the SMEs are regulated by the Chinese government. In fact, they are regulated by the Chinese government to some extent, but that's not the major, should not be the major regulator for them. The main responsible authority to regulate these SMEs, they are the African countries, and that's the sovereignty. And actually, all these foreign investors, they should just abide by the local laws. And of course, there's some like loopholes and some like weakness of African administration. Therefore, people are calling for some like this Chinese government to also monitor and regulate them. But that actually should not be the real power to do that, because it may cause conflicts between the legal sovereignty. So I would rather encourage the African regulation and administration to grow stronger together with the market growth, so that the whole the whole market in Africa can just nurture and develop. And as I said, as also in our report, we argued for that. When the market grows stronger, and that's the main interest of Chinese and also foreign investors. And then with a stronger market, then you can lead to a virtuous circle and lead to sustainable development. Yeah, thank you. That's just my 2 cents.
Thanks so much. We've reached the end of our allotted time. We would just, from Sia's side, we would love to thank ODI for working with us to host the African launch of this report. We really think it's a really important piece of work, and we're delighted to be part of its launch. We'd also like to thank Hannah, Anzetse, and Leslie for joining us today. And of course, the authors of the report, Linda Calabrese and Professor Tang Xiaoyang, for joining us today. It's fascinating to speak to all of you. And we're really thrilled that you could all join us. For everyone whose questions didn't get answered, we're so sorry we ran out of time. But I think, there's great opportunities to take it forward on Twitter and, and obviously, at future events. Finally, we'd just like to ask everyone to please complete the evaluation form in the chat window. And yeah, I'd just like to, from my side as well, to thank everyone involved and the ODI for this event. Thanks so much and enjoy the rest of your day.
Thank you, everybody. We will be ending the webinar shortly. Thank you.
Thank you. Thank you. It's a pleasure, really a pleasure. Thank you.